Hello, everyone. I am Kim, and it's been quite a while since I last conducted a live stream on this particular platform. In the past, I frequently discussed new stocks and highlighted various tech companies operating within the vibrant Hong Kong market during my sessions here, sharing insights and trends that could benefit viewers interested in investing. I look forward to reconnecting with all of you and diving back into these engaging topics that spark our mutual interest in finance and technology. Thank you for joining me once again, for joining me once. The new stock market in Hong Kong is still experiencing considerable volatility, but many innovative companies still possess significant potential for growth and success in the coming years. Investors should carefully assess their options before making decisions. Today's main topic is that there are several emerging trends to closely follow in the new stock market, and notably, tech stocks are experiencing a significant rise. This content primarily focuses on two significant areas: the emerging stock market trends and the promising Hong Kong internet tech stocks for the year 2024. We will summarize the hard work of 2024 and look forward to 2025, as well as discuss internet tech companies. Let's first take a closer look at the new and exciting stock market developments in Hong Kong. In 2024, the Hong Kong market saw 66 IPOs that collectively raised 78 billion HKD. In fact, the accurate total should reflect 70 initial public offerings, IPOs, which collectively raised an impressive sum of 80.844 billion Hong Kong dollars, HKD. This figure is based on data available up to December 23rd, prior to the additional listings scheduled on the 27th and 30th. In total, 4 companies were listed later, so the number of IPOs should be 70, with the total financing amount being 78 billion, but it should actually be around 80.8 billion. Compared to last year, the total number of financings decreased by 4, but the financing amount increased by over 70%. In the past 3 years, specifically from 2022 to 2024, the overall number of initial public offerings, IPOs, and the corresponding financing amounts have significantly decreased when compared to the more robust years from 2018 to 2021. Both the financing amount and the number of IPOs have clearly declined. Why is that? I previously discussed this important issue with you, and now let's take another closer look. The total amount of IPO financing relies on 2 main factors. The first is the total financing amount raised, and the second is the overall number of IPOs, especially focusing on the count of large IPOs being launched. Take a closer look here. These are the top 3 companies that received the most funding from 2018 to 2024, beginning with the year 2018. You can clearly see that from the year 2018 to the year 2021, the top 3 companies in each respective year consistently attracted very large and significant funding amounts. However, starting in 2022, this is for the year 2022. This is for 23, and this is for 24. The top 3 companies during this period had relatively small funding amounts, with Media Group being the least funded last year. The funding totaled 35.7 billion HKD, a substantial amount. If we exclude this particular funding source, then last year's total funding amount would be relatively quite small. Of the 66 IPOs totaling 78 billion HKD, Media represented 35.7 billion, nearly 45% of the total. In this particular situation, we anticipate that by the year 2025, the total number of initial public offerings, IPOs, occurring in Hong Kong may continue to be approximately in the range of 70 to 80, reflecting a stable market environment despite potential fluctuations. However, the total funding amount ultimately depends significantly on whether there are any large initial public offerings, IPOs. It is important to note that this trend is observed from 2018 to 2021. The substantial initial public offerings, IPOs, were predominantly concentrated among internet technology companies during that period, with notable examples including the rapidly growing company Xiaomi. In addition, in the year 2019, Alibaba successfully raised an impressive amount of $100 billion. These companies, including Alibaba and NetEase, were examples of secondary listing companies that fall into this particular category. At present, these significant initial public offerings, IPOs, primarily rely on the substantial companies that are already listed on the Hong Kong Stock Exchange to go public. This trend indicates that these may very well be the largest IPOs occurring at this particular stage in the market. As a result, the activity surrounding these major firms plays a crucial role in shaping the landscape of IPOs in Hong Kong. Next, for the year 2024, we carefully counted a total of 66 new stocks. However, the last 4 recently added new stocks were not included in this tally. How did these 66 new stocks perform overall? Out of 66 new stocks, 41 rose on their first day, 16 had gains over 20%, and 7 companies saw gains over 50%. The randomness of new stocks' first day performance remains quite significant. Let's take a closer look at the intricate relationship between first day performance and several other influencing factors. First, let's take a moment to discuss the correlation with the industry. It seems quite extensive, but what exactly does it truly mean in this context? It signifies that the performance of newly listed stocks on their first day can fluctuate significantly across various industries, reflecting diverse market conditions and investor sentiments. However, through careful analysis, we can identify specific patterns that help us avoid companies likely to experience significant drops, particularly focusing on those that show a first-day decline of more than 20%, which could indicate potential long-term issues. Many of these companies and initiatives belong to the rapidly growing new economy sector, which gained significant popularity and attention from 2018 to 2021, attracting investors and consumers alike with innovative technologies and business models. However, now that those years have passed and the leading tech companies have successfully gone public, the entire landscape has significantly changed. Currently, the newly listed companies in the market don't seem to have as clear a profit outlook or strong financial projections, so their first-day performances on the stock exchange aren't as robust or impressive as they were in previous years. Investors are approaching these listings with more caution, leading to a less enthusiastic reception on debut trading days. For instance, Kuaishou's initial public offering, IPO, in 2021 performed remarkably well in the market. Now, since those companies have successfully gone public, the distinctive characteristics of the current listings are not as pronounced or easily identifiable as they were in the past. This shift may reflect changes in market conditions and investor expectations compared to earlier times when such traits were more evident. For those companies that have experienced notable increases in their stock prices on the first day of trading, what insights can we summarize? Typically, they often tend to have much simpler and more straightforward business models. They are typically quite straightforward in nature and exhibit clear pathways to profitability. Relatively speaking, it may be somewhat easier to observe improved income performance in a particular market over time, including companies in various sectors such as labor services, construction, and gold mining. In reality, these various industries are typically quite straightforward and uncomplicated in their structure and operations. Additionally, there are various companies, such as Handu Beverage, that play a significant role in the market. While we do not aim to engage with every company available, we recognize that each investor possesses a unique perspective and understanding of the industry, which influences their investment choices and strategies. Some industries, such as labor services, gold trading, and environmentally friendly beverages, are quite straightforward and easy to understand in their operations. In these specific industries, everyone can easily see and understand the processes, making participation in such companies much simpler. Next, let's discuss the relationship between the first-day price increase and the oversubscription multiple. Does having a higher multiple truly guarantee a subsequent price increase? Not necessarily. I looked into this and analyzed the so-called DF enhancement schedule. Among the top 20 declines, the ones that exhibited notably high subscription multiples were Chabaidao and Mezhongjiahe, reflecting significant market interest. They experienced a drop. They had subscription multiples of 1,050 and 2,062 for different categories, respectively. However, this situation closely resembles what we encountered previously. Some companies seem to operate within the high-tech industries, showcasing advanced technologies and innovations. However, we do not have any information regarding what their potential profit prospects might be. For companies like this one, we can take the opportunity to observe their operations and strategies a bit more closely to gain better insights into their practices and performance. Regarding the companies mentioned earlier, in general, there is a clear trend. The higher the subscription multiple, the greater the likelihood of experiencing a price increase on the very first day of trading. This correlation suggests a strong relationship between subscription multiples and initial pricing behavior. If the industry is relatively straightforward and the subscription multiple is significantly high, then active participation in that market is advisable and could potentially lead to favorable outcomes and increased profits. China Resources Beverage is a simple and straightforward company. It also has a dense population. For instance, companies like Labor Gold and Maugiping are well known for their specific roles in the industry, and their market multiples are relatively high. Then there's Fujin China, which deals with agricultural products, and they also have high subscription multiples. Companies like these possess straightforward industry characteristics that are easily comprehensible to everyone involved. Furthermore, their overall profit outlook appears to be relatively clear and optimistic for the upcoming period. With a notably high subscription multiple, I firmly believe that their performance on the first day of trading is likely to be significantly better than anticipated, leading to a positive reception from investors. Another important point to consider is the overall performance of the company after the initial public offering, IPO. Many people frequently ask how long I should ideally hold onto a new stock after successfully winning it. Should I hold it for a full 3 months, half a year, 5 days, or maybe just 10 days? The ideal response is to carefully examine the first day performance alongside the significant price increases observed in these companies. Then check their overall performance after 5 days, 10 days, and 3 full months. This specifically refers to the day of the initial public offering, IPO, which is not included in the counting. We begin counting from the day after the IPO. From the second day onward, we closely analyze the stock price increases over periods of 5 days, 10 days, and 3 months. In other words, we thoroughly examine the top 20 companies based on their first day increase and analyze their performance after 5 days, 10 days, and 3 months. It has been less than 3 months since this was written. We can observe that companies exhibiting strong performance on their first day of trading tend to have a significantly higher probability of experiencing an increase in their stock prices over the subsequent 5 and 10 days, with this trend being particularly pronounced within the initial 5-day period. In other words, there is still some opportunity and room for reasonable expectation. Jingwei Tiandi surged 164% on its first day and rose another 32.8% over the next 5 days. However, in the subsequent 10 days that followed, it unfortunately fell back. It increased by 10.23% over 10 days, but rose 32.58% in 5 days. But Isho is similar. Some companies, however, can perform quite differently. Some may drop back significantly after a strong performance on the first day. Based on this chart, we can clearly see that overall, companies such as Fanzheng Huanggong exhibit strong and positive performance in the days immediately following their initial first day increase in stock value. To elaborate, that is to say, companies that experience significant increases on their first day of trading tend to perform remarkably well over the subsequent 5 to 10 days, with particularly strong performance observed during the initial 5-day period following their debut. There is still some available space for careful observation and analysis. However, companies that decline are different. Some investors wonder, if I notice a new stock today that has dropped 50%, can I think about bottom fishing for potential gains? This question has a very clear answer. Just look at how much it dropped on the very first day. How did it perform in the subsequent 5 and 10 days? This is precisely what. It's about companies that rise and succeed. The next 5 days of growth are simply an added bonus to their achievements. However, for many companies that drop on the first day, they don't see an increase in the next 5 days. Instead, they experience further declines. Most companies are like this. This company, I believe many people remember these two companies, Chinyu Intelligent and Duodian Data. Duodian Data just went public recently, in December. On the first day, it dropped 54.32%. I'm not counting that day. From the second day to the 6th day, it dropped another 54.42%. It's not just him. In fact, many other companies experienced similar outcomes. Out of the 20 companies that initially dropped on the first day of trading, only 2 managed to see significant increases in the following 5 days. Only these 2 companies showed any significant growth, which indicates that at least 90% of the 20 companies that experienced a notable drop on the first day had only about 10% that managed to increase in value over the next 5 days. So what does this mean? This means that if there is a notable decline on the very first day, the possibility of attempting to buy at a low price later on could involve relatively high risks. Let's summarize the key points. First, this year, the number of new initial public offerings, IPOs, is anticipated to be approximately 80, and the total financing amount will largely depend on the presence of several significant large IPOs in the market. Secondly, the observed relationship between increases on the first day of trading and the specific industry involved indicates that we can adopt a relative approach. This is particularly useful for companies that appear to belong to the tech sector, but present ambiguous profit prospects, helping us make more informed investment decisions. Even if the financial multiples appear to be high, if we cannot see the situation clearly, we can still take appropriate precautions to mitigate risks. Engaging in companies that operate in relatively straightforward sectors, which exhibit clear and promising profit potential, particularly when their financing options and subscription multiples are notably high, significantly enhances the opportunity for involvement and investment outcomes. Thirdly, it specifically concerns the stock price performance observed after the initial increase on the first day. Companies that surge on the first day tend to have a higher probability of rising in the following 5 days. So there is some room for participation, but it also depends on specific companies and requires analysis. However, after 10 days and 3 months, especially from the 7th trading day onward, the situation changes and there may be some pullback. For companies that experience significant declines on the first day of trading, the risk associated with bottom fishing for undervalued stocks may be relatively high. At the very least, when we examine last year's top 20 companies that experienced the largest declines on their first trading day, we notice significant trends. When we analyze their performance from the 2nd to the 6th trading days, we find that the risk associated with bottom fishing is quite significant. Secondly, let's take a closer look at the various internet technology companies. The internet industry. In fact, in the internet technology sector of the Hong Kong market, there are several sub-industries, one being internet technology companies and another being software development, which is included in the Hang Seng Technology Index, along with home appliances. This includes smart home appliances, as well as the consumer electronics supply chain and the new energy vehicle supply chain. However, here we will only discuss internet technology companies, such as Tencent and Alibaba. Why focus on this industry? If we look at the entire industry from last October, among the 12 major industries in the Hang Seng Index, 9 increased and 3 decreased, with the largest increase in information technology. In the field of information technology, it's essentially the industries I just mentioned, such as software development and internet technology. Industries such as software as a service, SaaS, are encompassed within this consulting technology sector, which is characterized by a significantly greater level of elasticity and adaptability, allowing for a more responsive approach to changing market demands and client needs. When the market is steadily on the rise, its elasticity may result in significantly larger gains over time. However, during an economic downturn, the company's losses may also be significantly larger than those experienced in other sectors of the economy. Secondly, as I previously mentioned, the 12 major industries represented within the Hang Seng Index performed remarkably well throughout the last year, showing resilience and contributing positively to the overall economic landscape. The Hang Seng Technology Index rose by 18.7% for the year. As I previously mentioned, the Hang Seng Technology Index exhibits greater elasticity and responsiveness compared to the traditional Hang Seng Index. This situation is primarily attributable to the varying characteristics and performance metrics among the individual constituent stocks that make up the overall index or portfolio. The Hang Seng Index comprises a diverse range of traditional industry companies, as well as various local firms based in Hong Kong. In contrast, the China Enterprise Index specifically excludes local companies based in Hong Kong, focusing instead on mainland Chinese enterprises. This distinction highlights the index's emphasis on companies operating primarily in mainland China, rather than those that may have significant local ties or operations in the Hong Kong region. As a result, it provides a different perspective on the performance of Chinese businesses, compared to indices that incorporate both mainland and local Hong Kong companies, thereby offering investors a more targeted view of mainland market dynamics. The technology index specifically includes a diverse range of companies that operate within the tech sector, encompassing various subfields such as internet technology, software development, and the manufacturing of smart appliances. This focused approach allows investors to track the performance and growth of innovative businesses that are at the forefront of technological advancements, providing insights into trends and market dynamics that are shaping the future of technology and consumer electronics. This also encompasses a wide range of consumer electronics, innovative new energy vehicles, and advanced software development. Now, Let's take a closer look at the detailed review of last year's overall market performance. Firstly, from January 3 to January 31, this specific period experienced a noticeable decline in various activities or metrics. This period actually continues the typical trend observed since August 2023, especially throughout this time frame. Starting from the second segment, in 71 trading days, the Hang Seng Tech Index rose by 37.58%, mainly due to the market's optimistic expectations for the Fed's interest rate cuts. The People's Bank of China started cutting interest rates and reserve requirements in February. Additionally, various supportive measures aimed at stimulating the real estate market contributed to a significant policy-driven rally, which exhibited considerable upward momentum and positively affected overall market confidence. However, as this is primarily a rally driven by specific policy changes, it is likely that once the policy environment begins to cool down or stabilize, the index may experience some significant pullback during this adjustment period. Investors should remain cautious and prepared for potential fluctuations. From May 21 to September 13th, over 81 trading days, the Hang Seng Tech Index fell by 10.85%, mainly because the Fed's rate cuts were slower than expected and the market's policy-driven rally began to cool. However, the overall extent of the decline was not significant enough to completely reverse the substantial gains that were achieved previously, because it had previously risen by 37.8%. The fourth segment, which everyone is quite familiar with, spans from late September through early October 7th, covering a total of only 14 trading days in that time frame. The Hang Seng Tech Index saw a significant rise of 54.79% during this period. At that time, it was also significantly driven by a series of positive and supportive policy measures. This included the central bank announcing further cuts to reserve requirements and interest rates, lowering existing mortgage rates, and reducing the mortgage ratio for second homes, along with the Fed starting to cut rates. The Fed began cutting rates last year, starting in September. So, in this context of multiple factors resonating, the index rose by 50.79% in a very short time. Of course, everyone is aware of the subsequent pullback. Since October 8th of this year, the Hang Seng Tech Index has notably experienced a significant decline in value. At that particular time, there was a noticeable cooling off of the policy-driven market, significantly influenced by the outcomes and implications of the US election process. However, in the subsequent trading days that followed, it has settled into a range-bound fluctuation, showing little movement in either direction. This indicates that the market is currently exhibiting some degree of divergence, suggesting that various sectors may be moving in different directions. To effectively change its overall direction, the market requires additional catalysts or significant events that could influence investor sentiment and drive broader trends. These catalysts could include economic data releases, corporate earnings reports, or geopolitical developments that would encourage a shift in market dynamics. Considering the various components of the Hang Seng Tech Index, the standout performers this time are Xiaomi, Trip.com, and Meituan, showing impressive growth. It's crucial to highlight two notable companies in the market, Bilibili and Meituan, both of which have demonstrated remarkable elasticity within the ever-evolving internet sector. Throughout the entire year, Bilibili maintained a rate of 51.71, but during its peak performance period, it impressively surpassed the 100% mark. This indicates that both Meituan and Bilibili exhibit very high elasticity in terms of their demand responsiveness. When in an uptrend, these two companies should be closely monitored. Bilibili, Meituan, and Xiaomi are popular brands in China. But what specific reasons contribute to their widespread recognition? This positive trend is primarily due to their significant involvement in car manufacturing, coupled with the impressive recovery of the consumer electronics sector observed throughout last year. Of course, Tencent serves as a central player in the industry. Companies such as NIO and Li Auto performed impressively in 2023, but they experienced a noticeable decline in their performance during the previous year. Baidu and Zhong'an are also part of niche sectors in the industry. As I previously mentioned, following this series of range-bound fluctuations, it is essential for us to identify and introduce new catalysts that can help us reassess and determine the future direction of the index. This will be crucial for making informed investment decisions moving forward. We will not analyze the phase trends. It's a crucial factor significantly impacting internet technology stocks or a broader technology index. Firstly, the overall valuation of the entire sector itself is currently considered to be remarkably low. When we analyze the price to earnings, PE, and price to book, PB ratios of the Hang Seng Tech Index, along with the broader Hang Seng Index, we can observe that these figures are significantly lower in comparison to those of the S&P 500. The Nasdaq Index currently exhibits a notably low price to earnings, PE ratio, and price to book, PB ratio, remaining low in comparison to its historical averages. It is also at a historical risk point of 9.09%, which is a relatively low position. To begin with, the overall valuation of the sector is currently relatively low compared to historical standards. However, I firmly believe that this valuation should align more closely with the actual performance and potential growth of the companies within the sector, reflecting their true value in the market over time. So the second point is the performance of tech companies, which we need to recall in detail. Their performance saw significant growth in 2021. It should have officially started in the second quarter of the year 2021. This remarkable shift was largely due to the unprecedented pandemic, which triggered a substantial boom in the online economy, resulting in significant and rapid growth for global internet companies that adapted quickly to the changing market conditions and consumer behaviors. The situation involves both Chinese and American internet tech companies. For instance, major companies like Google experienced substantial growth and success in the year 2021. This significant growth was the result of the remarkable online economic boom that transformed various industries and created new opportunities for businesses. Since the beginning of 2021 and continuing until approximately the second quarter of 2022, the performance growth rates of various internet companies experienced a notable slowdown. So, starting from the third quarter of 2022, the performance growth of these companies has been relatively slow. For instance, Tencent's financial performance in Q3 of 2022 saw a decline of 2%, while Alibaba's results were only marginally better. Baidu was at 194, JD.com at 544. Meituan was still in a growth phase, while NetEase and Kuaishou saw a relative slowdown in their growth rates, including Xiaomi. Xiaomi, as you can see, has been down for several quarters, all the way until Q3 of 2023. In 2023, following the complete lifting of pandemic restrictions, coupled with stable and sustainable economic policies designed to foster growth, and considering a relatively low performance base established in 2022, most technology companies have notably accelerated their growth trajectories. This includes Xiaomi, whose profit growth in 2023 has not been very fast. As of now, starting from the year 2023, the performance growth has become relatively stable and consistent. Tencent, as a prominent center within the industry, serves as a key benchmark for measuring overall performance and success in various sectors. Starting in 2023, Tencent's growth has become relatively stable. However, for certain companies, such as JD.com, the circumstances differ. Yet in general, most technology firms have experienced stable performance since the year 2023. Starting in 2024, the performance of tech companies remains differentiated, mainly concerning Baidu. Baidu's overall performance aligns closely with the not-so-great K-line chart that we all can clearly observe. This reflects Baidu's overall performance. When we assess growth, what key factors do we first consider in this evaluation? We examine a company's overall performance, and one of the most fundamental factors to consider is revenue. Only consistent revenue growth can ultimately pave the way for sustained profit growth. We cannot depend exclusively on cost-cutting measures to achieve long-term financial success and stability. It must be about profit. To achieve meaningful growth, we must consistently expand the overall revenue pie in order to sustain our profit growth over time. I strongly believe that revenue is absolutely fundamental to success. First, let's take a closer look at this revenue figure. In 2024, given the current situation, the performance of internet technology companies will be quite varied. Next year, in 2025, I believe the performance growth will still be diverse, with different companies showing varied results. Overall, I believe that many companies across various industries will continue to experience steady growth in alignment with the overall economic growth as measured by GDP, indicating a positive outlook for their performance in the coming years. Third, the trend of interest rate cuts by the Federal Reserve. The Federal Reserve's rate cuts significantly impact technology companies, both in Hong Kong and across the United States. First, it will bring about a substantial and meaningful institutional change that will impact various aspects of the organization. The notable surge that began in September 2024 is partially attributed to the Federal Reserve's decision to implement rate cuts starting at that time. In 2024, the Fed cut rates 3 times, in September, November, and December, totaling 100 basis points. This lowered the rate from 5.5% to 4.5%. The dot plot that was released after the December Federal Reserve meeting indicated that the current interest rate expectations for the years 2025, 2026, and 2027 indicate that the anticipated rate cuts may be less aggressive and significant than previously projected by financial analysts and market observers. However, as of yesterday, I thoroughly checked the data on investing, and I found that the probability of experiencing at least one rate cut in the first half of 2025 remains exceedingly high. The probability of a rate cut once is 42.9%, and the probability of 2 cuts totaling 50 basis points is 28%. Overall, this indicates that at least one interest rate cut is likely to occur. Probability stands at 70%, with the current rate level at just 21.8%. In general, although the uncertainty surrounding potential rate cuts this year is slightly greater than it was previously, financial analysts expect that at least one rate cut will occur in the first half of this year. This expectation reflects ongoing economic conditions and the need for adjustments in monetary policy. The probability is quite high. Another point is China's monetary and fiscal policies. China's market monetary and fiscal policies will directly impact the macroeconomic trends in our domestic market, which will in turn affect the performance of our tech companies. The Politburo meeting in December emphasized this. It has been stated that by 2025, more proactive macro policies will be implemented to stabilize the real estate and stock markets. More proactive fiscal policies and moderately loose monetary policies have already been set. The tone suggests macro policies should be proactive, with aggressive fiscal policies and moderately loose monetary policies. In this context, during this particular year, expectations for reductions in the reserve requirement ratio and interest rate cuts continue to be present, as the annual percentage rate, APR, still requires a downward adjustment. However, any cuts to reserve requirements may specifically target larger banking institutions that are currently adhering to a 5% reserve requirement. This approach aims to stimulate lending and economic activity among these significant players in the financial sector. These banks are unlikely to see any further cuts in their rates. Most banks, particularly large state-owned and joint stock banks, still have some flexibility for adjustments. Overall, this year's macro policy tone is more proactive, with fiscal policy being more aggressive and monetary policy being moderately loose. In this situation, there is still a significant possibility of reserve requirement ratio cuts and rate cuts this year. The final point to consider is the importance of market liquidity. Market liquidity can be viewed from 2 aspects. First, if the Federal Reserve lowers interest rates, it may increase the funds for equity allocation in the Hong Kong market, thereby enhancing liquidity. Secondly, southbound capital flows are increasingly participating in the dynamic Hong Kong stock market, now accounting for approximately 30% of the total trading volume observed. Last year, particularly during the final quarter, the net inflow of southbound funds remarkably increased by 744 billion. With southbound investment funds continuing to stay active in the market, the substantial impact on technology companies and the overall financial market landscape is quite significant. Overall, we can see that since 2015, net purchases of southbound funds have been continuously increasing. From 2025 to now, southbound funds are expected to remain very active. Lastly, let's carefully examine the diverse classification of internet technology companies operating within the Hong Kong market. One notable category consists of comprehensive internet companies, with Baidu and Tencent being the primary examples. For these companies, continued and sustained macroeconomic growth is expected to significantly drive their online advertising revenue and overall growth in digital marketing activities. This trend highlights the importance of economic conditions for their business performance. The expansion of domestic demand and recovery of consumption are both important. This development will significantly boost the growth of online payments, particularly for the company Tencent. However, potential risks could arise if overall economic growth falls significantly short of expectations, resulting in decreased online consumer spending. E-commerce faces similar challenges. E-commerce primarily encompasses major platforms like Alibaba, JD, Kuaishou, and Meituan, all of which fit neatly into this category. They are comprehensively expanding domestic demand, which will boost online consumption and accelerate growth, while the growth base for e-commerce in 2024 is relatively low. In this particular area, the performance growth base is relatively low, primarily referencing the major players Alibaba and JD, whose growth foundations are indeed quite minimal. In 2025, faster growth is anticipated under these conditions. Additionally, the current e-commerce competitive landscape is becoming clearer. The competition in the year 2024 is likely to be exceptionally intense, as various platforms such as Pinduoduo, Douyin e-commerce, and Kuaishou e-commerce are expected to pose significant challenges and obstacles to established giants like JD and Alibaba in the rapidly evolving market. As time progresses, the competition within these specific industries is becoming increasingly distinct and much clearer to observe. In this manner, when competition is not particularly fierce or intense, there exists ample room for a sustained and steady increase in net profit margins. Moreover, there is the aspect of e-commerce going overseas. JD's impressive overseas expansion is widely recognized, especially in the rapidly growing sector of cross-border e-commerce. The three major competitors in this space include Alibaba, the Douyin ecosystem, and Pinduoduo. Their strategic overseas ventures significantly contribute to enhancing their overall performance and growth in international markets. Conversely, if these crucial aspects fall significantly short of expectations, it will inevitably put considerable pressure on their overall performance growth. I'm going there. There are three prominent technology companies based in Hong Kong: Meituan, Trip, and Tongcheng, each with unique services. Similarly, first, the sustained growth of the macroeconomy drives continuous consumption growth, and the significant increase in inbound and outbound tourism benefits companies like Ctrip and Tongcheng. The ongoing and steady growth of community e-commerce is becoming increasingly clearer, resulting in a further reduction in financial losses. In 2024, not uniformly across all sectors, but specifically for individual quarters, Meituan's community e-commerce might reach a break-even point in its innovative business efforts. Once they successfully reach profitability, their profit margins could potentially further increase over time. Then, there are three main companies in the gaming sector. Tencent, which is a large company. The prominent companies are Tencent, NetEase, and Bilibili. In this specific context, I firmly believe there is a distinct hedging effect in gaming that necessitates time to effectively accumulate. At the same time, their various overseas gaming ventures are proving to be quite beneficial. Next, we should place our attention on the ongoing progress and development of exciting new games from these major gaming companies in the industry. Lastly, in the broad video sector, there are mainly two players, Kuaishou and Bilibili. We need to pay attention to whether Bilibili can achieve profitability this year, especially in Q4 and the first and second quarters of 2025. They may need to reach a specific break-even financial point. This is certainly a significant point of focus for them in their current strategy and planning efforts. Another important point that hasn't been specifically mentioned yet is the ongoing buyback efforts of these large tech companies. We can clearly observe the stock buybacks that were executed last year in 2024. The top 5 companies. First is Tencent, a major player in the tech industry, followed by other notable companies like HSBC, AIA, Meituan, Kuaishou, and Xiaomi, all of which are actively engaged in significant buyback efforts. In the context of ongoing buybacks, this certainly provides some support for their stock prices. Of course, several prominent companies are listed on both the US and Hong Kong stock exchanges, such as Alibaba, JD.com, NetEase, and Baidu. Companies may conduct buybacks in the US stock market via ADRs, while in Korea, there appear to be no buybacks. However, when these companies return to the US market, they continue to offer substantial support for their stock prices. So, These key concerns for tech companies include asset liquidity, China's monetary policy, and the Federal Reserve's trend of interest rate cuts. Additionally, the performance and valuation of the tech sector are also critically important factors that require attention. Lastly, it's fundamentally about the market dynamics and their strategic buybacks to enhance shareholder value. That's what we thoroughly discussed during our meeting today. Now let's see if there are any questions or clarifications needed. I believe that the primary focus remains on newly emerging stocks. Some tech companies demonstrate greater elasticity, which allows for increased flexibility in their operations and strategies. In terms of new stock opportunities, I believe we should focus our attention on 3 specific companies that show great potential for growth and investment. Especially those with relatively straightforward performance metrics, where everyone can easily observe and understand the landscape of the industry. Moreover, they have a large user base. Companies that possess clear and well-defined performance prospects tend to exhibit a significantly higher potential for participation in various opportunities. All right, that's all for today's exciting live stream session. We'll discuss much more next time. Next time, we will schedule another informative discussion on the topic of live streaming. Thank you very much, everyone.